How many hours do you think you have to get your money out of a bank before the government freezes the accounts? In Cyprus, they had zero. People went to bed with their savings intact. They woke up to discover that 47.5% of their deposits over 100,000 euros were gone. Not lost in a market crash, not stolen by hackers, confiscated by law to save the banks. That was March 2013. And the terrifying part? The European Union didn't call it theft. They called it a bail-in. They wrote it into law. And today, 27 countries across Europe have that exact mechanism sitting in their legal codes, waiting to be activated the moment another banking crisis hits. France just crossed into the danger zone. Their debt-to-GDP ratio hit 114%. Their deficit is 5.5%. They're trapped in the euro, unable to devalue their currency. And the numbers say they're following the exact same sequence that destroyed Greece in 2010. Except France's economy is 10 times larger. If France collapses, it doesn't just take down France, it triggers the legal mechanism that puts your savings, my savings, and the savings of millions of Europeans directly in the crosshairs. This video is about one idea. When a country can't print money and can't escape its debts, someone has to pay. And in the European Union, the law says that someone is you. I'm the debt archivist. My job is to dig through old files to find the patterns your news never explains. Today we're opening the file on France's structural debt crisis and the 2026 bail-in trap. This isn't speculation about what might happen. This is documentation of what already happened in Cyprus, what the law already allows, and why France is walking into the exact same mechanism that confiscated depositor money 12 years ago. Let me tell you about a weekend in March 2013. That changed European banking forever. Cyprus, a tiny island nation in the Mediterranean, seemed like an unlikely place to set a precedent for the entire continent. But that's exactly what happened. The setup looked stable on the surface. Cyprus had joined the euro in 2008. Their banks were huge, holding assets worth 6.5 times the country's entire GDP. Russian oligarchs loved Cypriot banks because of high interest rates, low corporate taxes, and easy access to European financial markets. Over $120 billion sat in Cypriot deposits, including $60 billion from Russian corporations alone. Then Greece imploded. When Greek government bonds were written down by 50% in 2011, Cypriot banks, which held massive amounts of Greek debt, lost over 4 billion euros overnight. That's 22% of Cyprus's GDP gone. The banks were insolvent. The government couldn't bail them out because Cyprus itself was broke, running deficits and unable to borrow from markets. Here's where the trap closed. Cyprus asked the European Union and the IMF for help in June 2012. They needed a bailout. But by March 2013, negotiations had reached an impasse. The Troika, the group consisting of the European Commission, European Central Bank, and IMF, had a new idea. Instead of taxpayers across Europe paying to save Cypriot banks, why not make Cypriot depositors pay? On Saturday, March 16, 2013, the announcement came. Every bank account in Cyprus would be taxed. Accounts under 100,000 euros would lose 6.75%. Accounts over 100,000 euros would lose 9.9%. Everyone with money in a Cypriot bank would wake up poorer to save the banking system. The reaction was immediate panic. ATMs ran dry within hours as people tried to pull cash. But it was too late. Banks were ordered closed on Monday, March 18th. Capital controls were imposed. You couldn't withdraw more than 100 euros per day. You couldn't transfer money abroad. The government had frozen the entire financial system. Then something remarkable happened. The Cypriot parliament rejected the plan. Citizens were in the streets. The idea of taxing insured deposits, accounts under 100,000 euros that were supposed to be guaranteed by European law, was so outrageous that even politicians facing economic catastrophe couldn't vote for it. So the Troika came back with a revised offer. This time, they went after the big deposits only. Cyprus Popular Bank, known as Laiki Bank, would be shut down completely. All deposits over 100,000 euros in Laiki would be wiped out, 100% gone, to cover the bank's losses. In the Bank of Cyprus, the country's largest bank, deposits over 100,000 euros would be converted into shares of the bank. a process called a bail-in. Initially, the conversion rate was set at 37.5% of deposits over 100,000 euros turned into worthless bank shares. But after independent valuation, the number increased. 47.5% of uninsured deposits in the Bank of Cyprus were seized and converted to equity. Think about what this means in practice. You're a small business owner in Cyprus. You have 300,000 euros in your account, money you need for payroll, for suppliers, for operations. You wake up on March 26th to discover that of your 200,000 euros above the insured limit, 95,000 euros are now shares in a failing bank. Shares you can't sell, shares that might become worthless, your working capital, gone overnight. Thousands of businesses faced exactly this situation. Unemployment surged to 15%. GDP contracted by 6% in 2013, another 2% in 2014. Families relied on extended relatives for survival because their savings had been confiscated to recapitalize the banks. But here's the crucial detail almost everyone misses. While ordinary Cypriots were trapped, unable to access their money, the London branch of Laiki Bank stayed open. No withdrawal limits. The Bank of Cyprus had a subsidiary in Russia. No withdrawal limits there either. International investors walked in and pulled out all their exposed funds, while capital controls prevented locals from doing the same. That's why the confiscation percentage kept rising. The big money escaped through the back door, leaving regular depositors to make up the shortfall. The president of Cyprus at the time, Nikos Anastasiades, his family members moved 21 million euros out of Laiki Bank in the week before the bailout was announced. Leaked documents proved it. The people who knew what was coming got out. Everyone else paid the price. Cyprus set a precedent. For the first time in modern European history, bank depositors were bailed in, their savings seized to save the financial system. And the European Commission didn't call it a mistake. They called it a template. Jeroen Dijsselbloem, president of the Eurogroup, said in March 2013 that the Cyprus model could be used across Europe. He later tried to walk it back under pressure, but the message was clear. Depositor money was now on the table. 1 year later, in 2014, the European Union made it official. They passed the Bank Recovery and Resolution Directive, known as the BRRD. Every EU member state was required to implement it into national law by January 1, 2016. 27 countries now have this law. It gives regulators the power to write down, cancel, or convert bank liabilities into equity before a bank becomes insolvent. And deposits over 100,000 euros are liabilities. The law is clear. Before taxpayers pay a cent, depositors pay first. Your savings can be confiscated, converted into shares of a failing bank, and there's nothing you can do about it because it's legal. Now let's talk about Greece. Because Greece and France look remarkably similar, except France is 10 times bigger and trapped just as tightly. In 2010, Greece faced a debt crisis. Their debt-to-GDP ratio was 130%. Their deficit was 15.4% of GDP. Markets stopped lending to them. Interest rates on Greek bonds spiked. The government couldn't pay its bills. Greece asked for a bailout. Here's the trap Greece was in. They were in the euro. They couldn't print their own currency. They couldn't devalue to make exports competitive. They couldn't lower interest rates to stimulate the economy. Normally, when a country faces this situation, they devalue their currency by 20, 30, 40%. It's painful, but it works. Iceland did it in 2008 and recovered quickly. Greece couldn't. The European Central Bank controlled monetary policy for the entire eurozone, not for Greece specifically. So Greece was stuck. They had to cut spending, raise taxes, and hope they could shrink their deficit fast enough to regain market confidence. It didn't work. The Troika imposed brutal austerity. Public sector wages were cut by 20%. Pensions were slashed. The retirement age increased. The minimum wage dropped. Unemployment hit 27%. Youth unemployment reached 30%. GDP contracted by 25% over 6 years. The debt-to-GDP ratio didn't improve. It got worse, climbing to 180% by 2014 because the economy was shrinking faster than the debt. Greece was trapped in a doom loop. Austerity killed growth. Less growth meant less tax revenue. Less revenue meant bigger deficits relative to GDP. Bigger deficits meant more austerity. Round and round. Now look at France in 2025. Debt to GDP ratio 114%. Deficit, 5.5% of GDP. Interest payments alone will hit 66 billion euros in 2026, making debt service the largest item in the government budget, bigger than education. France is trapped in the euro just like Greece. They can't devalue. They can't print money. They can't set their own interest rates. France's government tried to pass a budget with 44 billion euros in savings, including cuts to public holidays and pension freezes. The government collapsed. Prime Minister François Bayrou lost a confidence vote. Political gridlock prevents any serious fiscal adjustment. Meanwhile, credit rating agencies have downgraded France's debt. Moody's dropped them from HA2 to AA3. Borrowing costs are rising. The spread between French bonds and German bonds has widened to the highest level since the eurozone crisis. France is following the exact same pattern Greece followed in 2010. High debt, high deficit, political dysfunction, rising borrowing costs, and no monetary escape valve because they're in the euro. But here's the difference. Greece's economy was 200 billion euros. France's economy is 2.9 trillion euros. France is the second largest economy in the eurozone after Germany. If France goes into crisis, it doesn't just affect France, it triggers contagion across southern Europe. Italy, Spain, Portugal, they all start to look vulnerable. Bond yields spike, and suddenly the European banking system is staring at massive losses on sovereign debt. That's when the bail-in mechanism activates. Because the law is already written, the precedent is already set, and depositors are first in line. If you strip away the details, the pattern looks like this. Stage 1. Cheap money and easy debt. For years, France borrowed at near zero interest rates thanks to the European Central Bank's ultra-loose monetary policy. Deficits didn't matter because debt was cheap. The government spent freely, protecting citizens from inflation, subsidizing energy, expanding social programs. Debt to GDP climbed from 60% in 2000 to 114% today, but nobody worried because markets kept lending. Stage 2. Everyone calls it sustainable. Politicians in Paris insist France's debt is manageable. Economists say the debt to GDP ratio will stabilize. The European Commission issues warnings but takes no action. Investors keep buying French bonds because France is too big to fail. The euro gives France credibility. Markets assume Germany will never let France collapse. So, the borrowing continues. Stage 3. First cracks appear. Deficit hits 5.8% in 2024. The European Commission formally warns France they're violating the Stability and Growth Pact, which limits deficits to 3% of GDP. Credit agencies downgrade France's rating. Bond yields start to rise. The spread between French and German bonds widens, but the government insists everything is under control. They propose a budget with spending cuts. The budget fails. The government collapses. Political chaos prevents any meaningful reform. Stage 4. Authorities double down. Instead of addressing the structural deficit, France borrows more to finance the deficit. Debt to GDP is projected to hit 120% by 2027. Interest payments consume a larger share of the budget every year. The government proposes tax increases on high earners, cuts to public holidays, freezes on pensions. None of it passes. The political system is paralyzed. Meanwhile, the deficit keeps growing because spending cuts are politically impossible and tax increases don't generate enough revenue when the economy is weak. Stage 5. Confidence breaks. This is where France is heading in 2026. Bond markets lose faith. Investors start to question whether France can service its debt. Yields spike. The spread between French and Italian bonds narrows because markets start to see them as equally risky. Capital begins to flee. Wealthy individuals move money out of French banks. Corporations shift deposits to Germany or Switzerland. Bank runs don't happen all at once. They happen slowly, then suddenly. Stage 6. Forced reset. This is the bail-in moment. When confidence breaks, French banks face a liquidity crisis. Depositors are pulling money out faster than banks can replace it. The European Central Bank steps in with emergency liquidity, but that's just buying time. The banks need capital. The French government can't bail them out because France itself is in debt distress. So the BRRD activates. Regulators write down bank liabilities. Bonds get wiped out. Deposits over 100,000 euros get converted into equity. It's Cyprus 2013, but 10 times larger. The math says France is on stage 4, heading into stage 5. The only question is timing. Will it happen in 2026, 2027? Does it matter? The sequence is already in motion. Let's talk about the psychology that makes this inevitable. The people making decisions, politicians, central bankers, depositors, are all trapped by incentives that guarantee this outcome. Politicians face re-election. In France, proposing real fiscal reform is political suicide. Cutting pensions means losing retirees. Cutting public sector jobs means losing unions. Raising taxes on the middle class means losing everyone. So politicians do what politicians always do. They promise reform, propose modest cuts that won't pass, and hope the crisis holds off until after the next election. Prime Minister Bayrou tried to push through $44 billion in savings. His government lasted weeks before collapsing. No French politician has the mandate or the courage to impose the kind of austerity that would actually stabilize the debt. Central bankers at the European Central Bank are trapped too. They have one mandate: price stability across the eurozone. They don't have a mandate to save France specifically. If France's problems were isolated, the ECB could maybe intervene. But France's problems aren't isolated. Italy's debt to GDP is 140%. Spain is over 100%. If the ECB starts buying unlimited French bonds to suppress yields, they set a precedent that every southern European country will demand. The ECB becomes the lender of last resort for fiscal irresponsibility. That's politically unacceptable to Germany and the northern countries. So the ECB hesitates. They provide emergency liquidity to banks, but they don't solve the underlying problem. Depositors, regular people with money in French banks, are the most trapped of all. They don't know the law. Most people have no idea that the BRRD exists or what it allows. Even if they did know, what are they supposed to do? Move their money to Germany. That requires a German bank account, which requires residency or a business presence. Move it to Switzerland? Swiss banks don't want small retail depositors. Buy gold? That requires selling financial assets, paying taxes, finding storage, and then what? You can't pay your bills in gold. The average depositor has no good options, so they do nothing. They trust that the government will protect them, that deposit insurance up to 100,000 euros is sacred. But Cyprus proved that trust is misplaced when the crisis is big enough. This is the psychology that guarantees disaster. Politicians can't make the hard choices. Central bankers can't bail out fiscal problems. Depositors can't escape even if they see it coming. Everyone is locked into roles that lead to the same outcome. The debt spiral continues until confidence breaks. Then the bail-in activates. The pattern has played out twice already. Cyprus in 2013, Greece in 2010. Though Greece didn't have a bail-in because the BRRD didn't exist yet. They just had brutal austerity instead. France is next. The numbers say so, the incentives say so, the law says so. Here's what France looks like right now in December 2025. Debt, 3.3 trillion euros. That's 48,000 euros for every person in France. Debt to GDP, 114%, the third highest in the eurozone after Greece and Italy. Deficit, 5.5% of GDP, nearly double the EU limit. Interest payments projected to hit 66 billion euros in 2026. The European Commission forecasts that France's debt to GDP will reach 120% by 2027. That's if everything goes right, if growth holds steady at around 1%, if there's no recession, if interest rates don't spike, if political dysfunction doesn't get worse. But what if things don't go right? What if France enters a recession? Growth goes negative, tax revenues fall, unemployment benefits spike. The deficit balloons to 7 or 8% of GDP, debt to GDP hits 130%. At that point, markets start to price in default risk, bond yields jump. Suddenly, France is paying 4 or 5% interest on new debt instead of 3%. That adds tens of billions to the interest bill every year. The doom loop accelerates, or what if political paralysis continues? Right now, France can't pass a budget. No party has a majority. The far-right National Rally Party, led by Marine Le Pen, is the strongest political force, polling at 35%. They promise tax cuts and oppose austerity. If they come to power, fiscal discipline disappears entirely. Markets will react. Or what if contagion starts? Italy's debt is 2.9 trillion euros, 140% of GDP. Spain is at 100%. If France's bond yields spike, Italian and Spanish yields spike too. Suddenly you have a Southern European debt crisis that makes 2010 look small. The ECB can't bail out France, Italy, and Spain simultaneously. The sums are too large. France is trapped in the euro. They can't devalue. They can't inflate away the debt. They can't print money to buy their own bonds. The only options are austerity, which destroys growth and makes the debt worse, or default, which triggers the bail-in mechanism. Let me be very clear about what the law allows. The Bank Recovery and Resolution Directive, implemented across 27 EU countries in 2016, gives regulators explicit power to bail in depositors. Here's how it works. If a bank is failing or likely to fail, regulators can impose losses on creditors to recapitalize the bank. The order is shareholders first, then bondholders, then uninsured depositors. Deposits up to 100,000 euros are supposed to be protected in all circumstances. But deposits above that limit are fair game. In practice, this means if you have 200,000 euros in a French bank and the bank fails, your first 100,000 euros is insured. Your second 100,000 euros can be seized and converted into shares of the bank. Those shares might be worth 50 cents on the euro. They might be worth 0. You have no control, the regulator decides, and here's the mechanism that makes it unavoidable. Banks can be put into resolution over a weekend. On Friday, your account is fine. On Monday, it's frozen and a portion is gone, just like Cyprus. Capital controls get imposed. You can't withdraw more than a few hundred euros per day. You can't transfer money abroad. By the time you realize what's happening, it's too late. France isn't there yet. French banks aren't failing right now. But the mechanism is in place, waiting, and if France enters a debt crisis that spills over into a banking crisis, the BRRD activates automatically. It's not a policy choice, it's the law. The precedent is set, the law is written, the sequence is in motion. France is on stage 4, heading to stage 5. When confidence breaks, the bail-in follows. So, what does this mean for you? You don't control French debt policy. You don't control the European Central Bank. You don't control the BRRD. But you can control whether you understand the system you're operating in. Most people think bank deposits are safe. They're not. They're unsecured liabilities. The bank owes you money, but if the bank fails, you're a creditor, not an owner. And creditors take losses before taxpayers. That's the law. Most people think deposit insurance protects them. It does, up to 100,000 euros. But if you have more than that in a single institution, the excess is exposed. And if you're a business, your operating capital is exposed. A business with 500,000 euros in payroll sitting in a bank account is at risk. Most people think the government will step in to protect them. Cyprus proved otherwise. When the crisis is big enough, when the sums are too large, when the political will doesn't exist, depositors pay. Understanding this pattern gives you a framework. You stop trusting any currency as untouchable. You stop assuming that what's in your bank account is truly yours. You start thinking in terms of counterparty risk. The bank is your counterparty. If the bank fails, you have a claim, but claims get written down in resolution. This isn't about fear, it's about clarity. The debt trap is mathematical. France's debt is growing faster than their economy. Their deficit is structural. They can't escape the euro. They can't print money. The only way out is through austerity that destroys growth or default that triggers bail-ins. Either way, someone pays. And the law says that someone is depositors above the insured limit. You don't need to panic. You need to understand the stage we're in. France is in the danger zone, not in crisis yet, but the cracks are forming, bond yields are rising, political dysfunction is worsening, deficit projections are deteriorating, the sequence is unfolding. If you're in Europe, if you have deposits above 100,000 euros in a single institution, you're exposed. The risk might be low right now, but the mechanism is in place, and history says that when the crisis comes, it comes fast. Cyprus happened over a weekend. Greece went from stable to chaos in months. This pattern repeats because the incentives never change. Politicians delay. Central bankers can't solve fiscal problems. Depositors trust until it's too late. And every time, the result is the same. The debt becomes unsustainable. Confidence breaks. Someone pays. And that someone is always the one who didn't see it coming. France in 2026 looks like Greece in 2010, except bigger. And the bail-in law is already written, waiting. The archive doesn't predict the future. It shows you the sequence we're already in. France crossed 114% debt to GDP. They're running 5.5% deficits. They're trapped in the euro. Political dysfunction prevents reform. Bond yields are rising. The pattern says confidence will break. And when it does, the BRRD activates. If you want more calm, no-nonsense breakdowns of how debt, empires, and currencies really behave, subscribe to the Debt Archive. We open the files others ignore. We show you the patterns the news never explains, and we help you understand the system you're operating in before it's too late. The file on France is open. The countdown is running. The law is clear. Your savings are in the sequence now. Don't say you weren't warned.